Ladies and gentlemen, I'd like to introduce you to our panelists for Straight Talk, Getting Traditional Loans in Today's Economy. Brian Moeller, SVP and Director of Small Business Banking, Los Angeles Metro, Orange County Community Bank, Wells Fargo and Company. Shane Pearson, VP of Business Development, Pacific Premier Bank. Troy Bosch, SVP, Small Business Banking, Bank of America. And our moderator, Jane Wells of CNBC.
Good morning. Hey everybody, how are you? A quick question before we start. Show of hands, how many of you have applied for a business loan in the last year? How many of you succeeded? Oh, congratulations.
They're out there. They're out there.
You're the one. We're going to talk about how to bridge that gap today with traditional lending, which is probably your first stop for many of you. The D&B Credibility Corp survey with Pepperdine showed that 75 of respondents, small business respondents, reported that the current business environment as difficult to raise new business financing. 75% said it was difficult, 11% said it was easy. 44% of those who applied for a business loan from a bank were successful, only 44%. That is down from 50% in a similar survey last October. And finally, 41% of business owners say they transferred personal assets to their business over the last 6 months to keep it going, and more than half say a lack of access to financing. More than half say that lack is preventing them from hiring. So what we hope to do here today in a half hour of discussion and then followed by Q&A is to see if we can make that a little better, make that a little easier. I'm going to ask some questions of the folks with me. You were already introduced to Brian Moeller from Wells Fargo, Troy Bosch from Bank of America, and Shane Pearson from Pacific Premier Bank. So let's get right to it. Brian, I'm going to start with you. What is the biggest mistake the small businesses you see coming into Wells Fargo? What are they doing wrong when they're applying for a loan?
Gosh, that's a good question, Jane. A lot of times they come to appointments not quite prepared to talk about and disclose the full nature of their cash flow. And one mistake that I see small business owners make a lot of times is when they're trying to minimize their tax liability, sometimes they show a loss on their tax returns to minimize their tax liability. Authentic enough. Sometimes they pay themselves a very small salary out of their business, and when we look at the whole picture, on paper it shows, okay, maybe you have $25,000 in income to be able to pay for the loan or the debt service payments, but you have a $2,000 car payment, you have a $5,300 a month mortgage. You know, where is all this cash coming from or going to? And as a matter of fact, I was talking to a small business owner just 2 mornings ago, and here's a guy trying to get a loan, and it's just that his CPA advised him to show a loss on his business, and certainly he has enough expenses. I'm not suggesting he did anything illegal or wrong. Was paying himself a very little salary out of his business. He's trying to buy a house and he's trying to get a business loan. Well, on his tax returns, he's showing losses. On the salary that he's paying himself, it doesn't show enough money in order to pay for a mortgage, much less pay for a mortgage and the debt service on a business loan. But his business is successful. His business is growing. His business has doubled in size in the last 3 years. It has $400,000 in gross revenues. And what he's frustrated about is that we can't say yes because he's not demonstrating cash flow on his financials.
So he's doing the right thing for the IRS, but the wrong thing to get a loan.
I can't answer that question that way.
Well, yes, I will. So what's the solution? Because if you're this guy, he risks showing you something different and then having to pay a higher tax bill and still possibly not getting the loan. So what advice would you give this person?
I guess, well, the advice that I did give this person was you can't have it both ways. If you want to zero out your financials so that you have zero tax liability, That's fine and dandy. You might not have to pay Uncle Sam his fair share. But when you come and try to shop around and look for a loan, you're going to have problems. Businesses that are successful in getting great loans with the great rates available today, they are forthright. They're upfront with all of their sales and documenting their revenues and showing a profit. You know, we're proud that our company is showing a profit, and we pay our taxes. I personally pay my taxes, and I'm not suggesting that, you know, we are making any type of moral decision here. But as a banker, I need to understand your cash flows, and your cash flow has to be documentable, and I need to be comfortable with making those decisions. And also, we have regulators that look at these things. And if I say yes to a loan because I know there's cash flow somewhere, but it's not being reported, my regulator might say, hey, Mr. Moeller, why did you say yes to this loan? This is outside of our parameters here. More community banks, CDCs, angel investors, those types of lenders can be a little more flexible on things like that. But as a regulated bank, we have to make the right decision for the customer.
Well, Shane, that brings me right to you. Do you use some different metrics when someone comes to you with a loan application?
Yes, I believe it all comes to really the character of the borrower and how well they've got their business put together and their plan put together, because we do also allow for the opportunity for a borrower to base a loan off of projections. Maybe it's a business who hasn't quite hit cash flow in the last 2 or 3 years.
So
but
you take people with a little bit of a spottier record.
Scenario, yeah. So things that may, and that's, I'd say in the whole commercial and small business lending world, every bank has a different flavor. They all have a different way that they look at a transaction, and so it's not, in my opinion, it's not worth getting hung up on just maybe one bank, and that's kind of the end all for your transaction. You can move to another bank that may give you that flexibility to kind of fit your character and your small business into their portfolio. Again, just based on the metrics like he had mentioned.
Well, give me an example of somebody who would probably be turned down by Wells or Bank of America that would come to Pacific Premier, and you'd say, yeah, we'll take a
It's hard to say because I'm not working at their bank as far as what I can predict of what they've done. But as far as people who have hit my table in the past, short sales are very common today. Short sales of even foreclosures. People have had difficulty in the past few years where they've run into for instance, a contractor that I had that's come to the table has had a short sale on his house and has since reestablished credit. It's been about 3 or 4 years. Has built his credit back up, and his whole story that he has behind how he went into short sale lined up, so that we could consider the fact that it wasn't so much just a character issue, but the guy literally had a struggle that he couldn't control. The housing market crashed. All of his clients kind of went out the window, and so that made it difficult for him. But I think he's turned it around, and he got declined at another bank simply for the fact that it was just a short sale. I don't know, they didn't look at anything else, but that alone was a character issue for that bank that they didn't want to look past it. Whereas we've taken it in under our wing and considered it, and are taking the story into account, because now he has cash flow, he has collateral, he kind of has everything lining up. Now, needless to say, I don't know exactly what the underwriting criteria are for the other banks, but that one was a decline from a major bank that came to our table, and we're considering it.
It sounds to me like people coming to you need to have their story straight.
Exactly.
On what happened, what went wrong. Mm-hmm. And if it adds up, and then what? They've got stabilization going. They've got some kind of proof that they've turned the corner.
Exactly. They're turning their business around, that they have a plan of where to go. That business plan is critical. And you know, the good thing that I'm in the front end of it, I'm a loan originator, is I often get clients who come to me that may not have a complete plan. They've got it up here, but they don't have it on paper.
Really?
Where we can really take it and help them develop that plan. So I say it's hard because as a small business owner, you can easily get lost in the day-to-day, and it becomes difficult to step back and actually look at the systems that are integrated into your business and move it in the right direction. So if anything, when they come to get a loan, they're trying to take that step out, and so it's a good time to work with them and help them plan. And it could be as easy as a restaurant saying, I'm going to open now for breakfast and serve some burritos, breakfast burritos, and that can make a huge impact on their revenue generation. So that extra hour of clientele they didn't have before. Something small like that is kind of what I would help them put together, and we build a plan off of it and then submit it from there, as long as, again, the story just needs to line up.
So the breakfast burrito indicator is important.
There you go.
There you go. We'll call it the BBI. Troy, what is the biggest mistake you see small business people coming in when they apply for a loan?
Well, Shane had talked about having a plan, and one of the things I really hone in on is, when we're talking to a client or prospective client is, do you really know what the purpose is? Can you break down what the funds are exactly going to be used for? Are you looking at a short-term need, which is typically going to be where, you need some accounts receivable financing or inventory purchases or what have you? Or is it a long-term need where you've got equipment, you've got tenant improvements, you're buying a building, doing an expansion as far as maybe a new location or those type of things? It's really important because what we try to do as a bank is match the right product for the right need. And typically, with a line of credit, that's a short-term liability, so that's going to be matched up with a short-term asset, right? When you're looking at long-term improvements for the business, you're going to match that up with a long-term liability, which is going to be a loan. Oftentimes, you get clients that are mismatched and confused a little bit. Perfect example of that, I was out with a dentist actually earlier this week, and have a line of credit with us, traditionally never use it, and was getting reviewed financials and noticed there was a big balance owed on the line of credit. Start asking the question, what's going on with the business, right? Oh, we used that to buy a digital x-ray machine the end of last year, right? What we should have done at that time is done a lease or an equipment loan at that point because it's a long-term asset, right?
I mean, why? What's the advantage? Why would you want to switch to not do that on your line of credit?
So it's a great question. So with a line of credit, the way, we have covenants, we have stipulations as far as how it's to be used. And so with a line of credit, the expectation is that you zero it out. You have basically a 30-day out of debt period to show that you're using it for short-term needs, short-term assets. And so what we're doing with the dentist is we're basically going to take that money, turn it into a term loan, get on a payment plan, and get it paid off over 3 years, 5 years, or what have you, and then get back to using the line of credit for what it's intended, which is if you have short-term needs, seasonalities, those type of things that are where you're using it, paying it off, reusing it, paying it off, that type of scenario.
But does it save you money? I mean, if I'm the business owner, what's the cheapest way I can buy that piece of equipment?
Interest rates right now are very similar. What you want as far as a long-term obligation, you want to lock in a low fixed rate right now, right? You'd never buy a house using a line of credit, as an example,
Gotcha.
right? So you want to lock in today's low fixed rates, make sure you can budget out appropriately and then plan accordingly, and not have to be concerned about fluctuations in interest rates.
Do people really come in, and I'm sorry, and not know what they want the money? They can't articulate for you what they're going to do, and they have their receipts in a shoebox, and that really?
Absolutely. Yeah.
Really?
Yes.
Yes. We see it all the time. I mean, the things that Troy's bringing up, people using short-term money for long-term loan pieces. One really important thing that he touched on is to keep your payments predictable. So if you're using short-term money, let's say you want to buy a truck for your business, you have this $100,000 line of credit at B of A because Troy's my friend, and so found a great deal on truck, have the cash, pay for it, boom, done. That line of credit, like he said, they typically are one-year notes, and at some time during the year, it's a common stipulation that money needs to rest for 30 days. Let's say it's a $100,000 truck. Well, what happens on month 11 when Troy calls and says, hey, Brian, glad you're using the credit. Hopefully it's helping you with your business and cash flow, but we need that money parked back in the bank for the next 30 days. And if not, bad things are going to happen. And that's when people come into the bank with that look. You know that look on their face? Where
What is the look?
The look of, I need money, and I have a hard time articulating why I need this money.
Because I've been working 20 hours a day, and I'm really tired, and my business is fine, and here's my paperwork.
So unexpected expenses that come up, unexpected or unplanned for loan stipulation rest periods are two common things that business owners don't anticipate when they're using these short-term vehicles of credit. And a long-term loan, basically, you know what your payment's going to be. you're depreciating your asset over the years. You know when it's going to be paid off. You know what the payment's going to be next year and the following year. It's something that we as bankers are much more comfortable making a decision on. Plus the costs involved. Most of your short-term or line of credit dollars are tied to LIBOR or one of the other indices that today they're very low and it's very competitive with the long-term money right now. But the future risk of interest rates going up or some of these indices going up that you're tied to, it's like LIBOR plus 3 or plus 4, that payment on that $100,000 truck could go from $2,500 to $10,000 in a very short period of time.
Wow. You also said something to me about you can only get credit if you don't need credit. Explain that.
That's something that I hear people say sometimes, and it breaks my heart. The use of credit, Wells Fargo is known as a cash flow lender. We want to give people credit. We want to understand how it's going to help them with their cash flow, help them to grow their business, do an expansion plan to become more successful. And because we need to be able to predict what your cash flow is today, what it was the last 2 or 3 years, but more importantly, where it's going to be a year from now, where it's going to be 2 years from now, because you're going to be making payments on this loan. I need to know where the money's coming from. Now, when you come into the bank and you need money because either your business is failing, your sales are down, you have an unexpected emergency, and it looks like your sales or your revenues are going in the wrong direction, it's not easy for me to predict that your cash flow is going to be where it needs to be in order to support the loan. So if you, quote unquote, need money today, that need should be tied to your future growth plans. I need to use this money to plug a hole in my cash flow cycle in order to become more successful or get through this dip in a seasonality curve that I'm able to predict over time based on the past experience. Does that make sense?
No, yeah, it does to me. Shane, what do you think about that? And are you, you guys are in the business of making loans, right? You want to make loans. Mm-hmm. But you have your own standards so that you can. So then you have all these other sources that people can go to and maybe taking away good business from you if they work out. Shane, when you see people coming to you, are you asking them to reset their expectations?
Always. I think that what everyone should understand, I think both the lending side and the small business side, as far as the owners are concerned, is really a loan is just another form of investment. The bank is making an investment in you and your business. And so when we look at that, obviously we're going to want some type of return, and we're going to analyze that very carefully. At the same time, if you were going to go look to invest in, say, a friend is starting up a restaurant, you're going to measure everything you can. If you're not going to have hands-on control of that business, you're going to take every precaution you can to understand that individual and the way that business is going to operate. You're going to be smart with your money. So a bank is operating as an entity, but within that same realm. We're looking at, okay, this is going to be a partnership. I don't want the small business to fail, so we're going to go to whatever extent we can to ensure that we have a good, comfortable understanding of somebody who we've never met before up until today, in most cases. So when somebody's coming to us, you have to make sure you put together a clear understanding of what you want to do, and understanding that the bank is going to may be flexible on how they take your transaction and what they turn it into. So though you may come in and want $100,000, and you've got 70 of that you want to use for working capital and 30 for something that we can actually pay the bill on, that's a lot of cash to just kind of throw in your hands and us not having any expectation of how you're going to use it. So the bank may come back, and it's always good to be prepared for this. The bank may come back and rework a situation based on our investment analysis of how we're going to send money to you, and ensure that we know that you can really handle the money that we're going to be sending to you intelligently to move your business forward. So coming in with a plan and expecting that the bank may be flexible on how they put things together is critical. So if you can't drive a hard line with the bank and say that this is what I have to have and that's all I'm going to get. I think when you go to the bank, is understand that they may come back with a different pitch than what you originally came with, if your business makes sense.
Troy?
Yeah, I'll give you an example. We were talking earlier about, loan versus line of credit, and a lot of times we get pushed back on the loan because, well, I don't necessarily need the money right now. And so when Shane was talking about have an open mind for some flexibility as far as how we would structure a deal, one way to do that is, we have what's called a non-revolver to term. So during the first year of the facility, you're only paying interest on what you've used, right? And then at the end of that year, we then turn it into a long-term loan where we're getting you set up, Brian, as we talked about, on a budget, on a schedule, so we know what it is. So it's kind of a hybrid. It's a combination of both. When you've got that situation where a client's doesn't want to pay interest on money, and as you said, here, we've dumped $100,000 in your lap, I don't need it right now. You can do a non-revolver to term, which is a little bit of as I said, a hybrid that can meet the needs of both client and bank.
One of the suggestions out of this Pepperdine research is that, banks could do a better job of publishing minimum thresholds for different products. In other words, you could educate people before they come in so they could know whether or not they even qualify. What do you think about that, Brian?
As a small business owner, you can't get enough education. There are so many different products. Banks have different products. He's talking about these hybrid products, and we have some specialized products.
I mean, if I go on the Wells website for business loans or small business loans, am I going to get the kind of information, you have to need minimum revenues of, $500,000 a year, or that cash flow of this, that, and the other?
We have a lot of education materials on our different lending programs for small business at the Small Business Insights part of our website at wellsfargo.com, and I encourage people to check that out. But for us to publish parameters on individual loans, you have to understand that every business owner, as well as every business and how they're structured, is different and unique. And when you go to a doctor and you think that you need to have appendix surgery, it's like, well, I kind of want to go and find the right doctor and understand the right tools that you're going to be using in order to fix my appendicitis. And we think our bankers are similar to doctors. We want to be able to diagnose the business, diagnose what the right product is, because a lot of times small business owners think they need one type of loan that might have some very expensive upfront costs associated with it, or vice versa. They might think they need another type of loan that's not going to cost them anything. But we like to have a conversation first, and that's probably the most important thing when you're looking to get a loan, is to build a relationship with a banker that knows you. Let them in, invite them to your business, help them to understand how your business works so that they can come to the table with you and offer up suggested solutions for your problem. Most business owners, they walk into a bank branch and they say, I need a line of credit, even if they can articulate what they're going to use the money for. But as Troy was saying, that might not be the best fit loan for their business. So there's some risk at publishing all of those minimum standards.
What's the number one reason you turn someone down?
For business, I think it's thin file. A business not having established credit to begin with, it's hard to go through the business plan and try to predict the future revenue of this company. So how do we see that this business has longevity and that they have a credit file with some history that we can sort of look back and say, okay, this person has done this in the past, so it's easier to predict in the future. Right now, today, it's tough. People are having these new things show up on their credit reports. The mortgage crisis. People have walked away from homes. They've gotten mortgage modifications where there's been principal reductions that most mortgage companies count as charge-offs. These are delinquencies on their credit. Maybe their business looks great and their business credit they've kept pristine, but we take a look at the owner's personal credit and that could create a challenge.
Can't you at some point start to forgive that, overlook that? In other words, if they're 3 years, they're not quite off, it's not quite off their credit record yet, but they're 3 years away from a foreclosure now.
I think everybody's situation is a little bit different. I believe in second chances. And I know Wells Fargo believes in second chances. And we have secured business line products for people that are looking to get back on their feet again and reestablish their business as well as their personal credit if their file has too many delinquencies or derogatories. But in the situations where somebody makes a mistake or two, a lot of it depends on, what has happened since then. How have they conducted themselves in a credit situation after that event, after that bankruptcy? Did they make right on some other things, or did they basically leave all of their creditors high and dry, even though they had this income over here? So it's amazing the amount of information that you can learn about somebody's character and how they feel about paying the debts that they agreed to pay over time. So every situation is different, but the answer is yes.
It seems to me to go to your story, your point, Shane, that have your story about your credit history. What is the number one reason you turn someone down?
It's hard to identify a number one reason, again, because Brian brought up a good point. Every small business owner and every individual is different. So I haven't nailed down one thing as being the main reason for decline, because you've got multiple different facets that a bank looks at a transaction, and usually if there's one weakness but the other strengths are strong enough, it may be enough to overlook or overcome that one issue. You've got enough mitigants in place to kind of help you look past any of those issues, again, because nobody's perfect. There's rarely a perfect business out there, and if it is, usually they're not hitting our table.
But if only 44% of those who were seeking financing got it, that means most of them are being told no.
Yeah. My thoughts on that, a lot of banks right now are screaming back towards collateral. It's hard because most people who had their homes and that was kind of an investment to them that had value has disappeared. So you're at a point now that maybe your cash flow is still there, but banks are kind of looking for something to grab onto a little bit more because, the decisions that were made in the past and where they might be getting burned. So at the same time, a lot of banks are really trying to focus on, okay, what can we have that's tangible that won't run away from us if this thing goes apart? So I know collateral always tends to be a hang-up. It's not necessarily always has to be the case. Like I say, that may be the one thing that you have weakness or deficiency in, but everything else is lining up. But beyond that, I think with me, that's what I've run into the most, being in the front end of business and talking to clients every day. It's like if you have something you can bring to the table that's not going to run away from us, that may help us be more apt to give you a loan. That's not always that it's going to happen, because we're not trying to see the business go bad. In fact, we don't want you to ever miss a payment, for heaven's sakes. But
yeah, Jane, we have to be comfortable that the cash flows from your business are going to make the debt payments, and what I was talking about before, where businesses are showing very little income, they want to make a loan, but they're not showing the income that will support the payments on the loan. You ask a business owner, hey, is your business making money? What are they going to say? Oh, yeah, we're making lots of money. They bring in their package, and, the last 3 years you actually showed a loss. Where's the disconnect here?
Well, can they show you their tax returns and then also break it down? Here's the cash flow. Here's all our incoming cash. And here's what we wrote down. And I don't mean wink, wink, like you're trying to rip the government off. But is there a way to please both?
Absolutely, and that's why small business underwriting isn't done by computer model. It has to be done by human beings. An underwriter skilled in having these conversations has to have a conversation with somebody so that they can understand how the cash flow cycle works for their business. It's the only way we can do it. The question of collateral, we also need to be able to answer that question. Okay, if you don't pay us back the money, let's say we can find the cash flow, even though you're not reporting it, and what happens if you don't pay us back the money? And we might go to that collateral question. And we don't want to go to the collateral. We don't want to be in a position of having to ask you to sell something or lean on that personal guarantee. We want to make our decision on the cash flow, and we need your help to help us to understand that.
Troy, what do you think of all this? I mean, again, only 44% seeking a loan got one. That's...
Yeah, I would say the biggest obstacle is validating and verifying cash flow. Whether it's on the business side or on the consumer side, anybody that's tried to get a home loan, the years of stated income credit and stated income borrowing do not exist anymore, right? So we really have to find the cash flow, break down the cash flow, and ultimately, do the credit facility. Ironically, we talk about clients being able to pay back loans and what have you. What I'm running across quite frequently nowadays is for clients that are currently renting and looking to buy property, right? You don't realize how low interest rates are and how much of a building you can afford. And so we do analysis a lot of time where someone might be paying $10,000 a month in rent, a new mortgage payment, even on an SBA structure with a first and a second combined, maybe it's $8,500, maybe it's $9,000. People don't realize how low rates have gone to the point where when you compare it to a current rent situation, you're improving your cash flow. And when you look at cash flow, you're demonstrating ability to be profitable and afford a lease payment, a rent payment of $10,000 a month. We're reducing your payment. So those are the type of deals we get very excited about because it's all out in front of us. It's very predictable as far as what you can afford, and that improves our chances of being able to get the deal done.
What are some of the most unusual forms of collateral that you have contemplated accepting?
I got a call from a guy in Georgia last week. He might be listening on the internet today, so I'm not going to use his name, but very nice gentleman. He's in the business of selling hay in Georgia, and he was asking me about using next year's hay crop as collateral. So a futuristic, it's an agriculture type of loan, which I'm not a real specialist about. And as we started talking about his cash flow situation, it's very difficult to predict. For people like you from CNBC that understand the commodities world, hay is like gold right now.
It is, especially after the drought.
So for me to use next year's crop or a crop a year from now outside of your regular commodities price points.
A size of which you may not know how it will turn out to be.
Might not know. We have insects, we have weather, we have, where is he going to be in his business a year from now? It's very difficult for us to predict futuristic, organic pieces of collateral. But people do it. And we do loans on agriculture and future crops all the time.
Shane, what's the most unusual risk you took, loan you went for that has so far turned out okay? Can you think of one?
I'm trying to think back to some of the crazy things that I have seen. And I wouldn't even say it's that crazy because it's a true tangible piece of collateral. But in most cases, I've dealt with a world that doesn't often run into agriculture. I've kind of have a more specific niche that I work within on the SBA side that often doesn't come to the table due to eligibility issues and things like that. But I mean, the craziest was a tugboat up in Alaska. So something that could easily float away and over to China that we wouldn't be able to track down that they used to somehow, I don't recall the back office walkthrough that they had to go through to get it to work, but someone pledged their tugboat for crabbing or something like that to
Deadliest catch.
Yeah, that kind of a concept in order to get a loan to actually open up an office. They were going to build out a little office for their tugboat bit or their crabbing fishing business.
Did they get the loan?
No, it didn't end up going through because of the cash flow issue. So we can go back and look at the seasonality issues and a lot of problems there, but that was the most interesting request.
Troy, anything come to mind?
No hay, no tugboat. I would say
breakfast burritos.
Breakfast burritos. I would say where we've got most creative is with the assistance of SBA through an SBA 7A product, where we're looking at using different, whether it's homes, second homes, different collateral to get to a comfort level as far as being able to do the deal, whether that's a single family residence, the personal residence, or second home or what have you. That's where I see us being the most flexible. It's a terrific program. We can, a lot of times we cannot do it conventionally through our bank, but with that SBA guarantee, that helps us get over that collateral hurdle.
Well, federal guarantees. Let's talk. Without, I know you probably don't want to get political, but with the election upon us, a fiscal cliff, perhaps a change in administration, certainly here in California, Proposition 30 and 38, higher taxes. So many small business owners don't pay corporate tax; they pay personal income tax.
Both.
Well, yeah. Woohoo! If taxes go up, what does that do to these people, and does it make it harder for you to approve loans?
Okay.
Oh, Brian, you can
Brian
start.
I'll take this one.
Your name's up, the Wells Fargo logo's up there. So.
Okay, I'm not going to speak on behalf of Wells Fargo here, but I'll speak on behalf of a small business owner myself, because I do own a small business, a nonprofit. Which
oh, really?
My mom is a small business owner. She has a medical practice. She's an orofacial myologist. She's very concerned about taxes going up. So much so that she's holding off on making some purchases of things because she doesn't know what her tax liability is going to be in Q1 and in Q2 next year. So if she's feeling this way and she's not, I would say she's pretty familiar with some of the tax initiatives out there, but just that feeling that business owners have that I have this unpredictable expense coming up in the future and I don't know how much it's going to cost me, I think it gives them that feeling that they might not be as confident to make that investment in their business. Even if they have the cash, they might not upgrade their truck. Even if they have access to that credit, they may not invest in the marketing materials because they're waiting. They're on hold right now.
But let me ask you from an underwriter's perspective. Are you concerned? Are you holding back thinking that this person you are making a loan to may have a higher tax burden next year and therefore, yeah, you're shaking your head no.
It's too difficult to predict, and business and corporate tax law is very complex. And
it's not a factor in going over these applications now, what the tax situation may be in 6 months?
Okay, let me go back to the guy that I talked about earlier that was having a hard time getting a loan because his CPA guided him to zero out on his income, basically. I think it might create more business owners to be more aggressive with documenting their expenses in order to minimize their tax exposure, and it will actually end up resulting in them showing less income on their financial statements, thereby having a secondary effect of them having a harder time getting a loan. Does that make sense to you?
Yes, and also means less taxes.
And the government isn't going to collect the taxes that they might think that they're going to collect. I think the business community, and there's a lot of very excited CPAs out there that are getting ready for their boom time.
Flat tax. But okay, I'm going to just ask one more question before we go to Q&A. Shane, real quickly, where are you seeing, which segment are you seeing an increase in loan activity finally that's sort of coming back?
I've have a history of working with kind of, again, very niche businesses. That just comes from where I targeted in the various banks that I've worked for in the past. And but I've had a focus as of late and through the contacts that I've generated in the appraisal world that hospitality has actually kind of seen rates start to creep back up. So like more people are staying in hotels now, and hotels are kind of picking up their prices a little bit. So that the travel is back on, and so hospitality I have seen, at least in the revenues that I've run into, have started to trend back in a positive direction. Of course, that's all geographical in a lot of cases and where you're at in the country, because I do loans not just in Southern California. So it may be different in Southern California. The volume of hotels I run into is minimal here, comparable to like Texas, for instance, which we've seen a lot of economic growth there.
All right. Troy, very quickly, where you?
I'd say medical is the kind of the steady Eddie.
Medical.
That's been continuing to increase and grow. In general, I think manufacturing's doing well. Distributors, wholesalers, those type of things. So in general, I think things are improving. So kind of rising tide, brings up all ships type of thing.
Brian?
Real estate. California, the California economy, Southern California, real estate is back. Investor real estate.
I wouldn't. Is it back, or is it like crawling out of the muck and mire and getting oxygen?
Let me put it this way. In most of our communities here locally in the greater Los Angeles area, we've seen a flattening of real estate values or an improvement in some, in both commercial real estate and in residential real estate. Residential real estate is probably the #1 most important driver of small business owners getting access to capital for their business. They use their homes as collateral, not just with SBA loans, but I'll tell you, a lot of the best businesses in America were funded by people taking money out of their home, out of their backyard in a home equity loan or getting a line of credit. But as an underwriter, if I'm able to predict your piece of collateral, which the #1 most important piece of collateral that businesses have is real estate, because it's real, it's tangible, it's not going anywhere, it can't be taken across the border. If we're able to predict that next year it's going to be worth about the same or maybe a little bit better, that makes us so much more comfortable to say yes to this loan with this piece of collateral.
So it's more of your confidence in real estate as you see stability as the lender, so that you can make these projections now. You don't think it's going to lose another 5% next year, the house, that sort of thing.
We are saying yes to more loans for people doing real estate loans. We're seeing lots more investor real estates, people buying multi-unit apartment and condo projects coming through. People with strip malls and small projects. We're saying yes to a lot more of these loans than we were a couple of years ago, because when real estate values are in a trend that is declining and it looks like it might decline more, as an underwriter we have to kind of predict what we think that might be worth. That LTV, that loan to value conversation that is always so uncomfortable to have for some people. We need to kind of look at, okay, what's the best case and the worst case scenario, and then how much are we willing to sort of set aside that if you can't pay the loan back, what are we going to be able to wholesale sell this property for? And that's kind of what the collateral looks like. Well, if that is kind of trending down and I predict it to be less, I'm going to be a lot more conservative at how much value I'm going to give that collateral. So in turn, you're going to get a much lower loan. Well, if I'm able to kind of predict that it's going to be flat or better, that opens up that equity, that collateral base that you can then leverage and borrow from. So it's not just Wells Fargo. I know we're seeing roughly a 32% increase this year over last year in our small business lending, but Bank of America, Chase, lots of our peers are seeing the same. We have great growth in commercial and business real estate.
All right, let's take some questions from the audience. Mike and Jessica, do you have someone? Raise your hand if you have a question, and we'll bring a microphone over to you.
Here, we have a question over here.
Yeah, I have a question. About 2 years ago, we tried to do an SBA loan for about $450 using a property in New York that had about the equivalent amount of equity in it. We owed $350 on a property that was worth about $850, and we just got shot down left and right. It was actually unbelievable to me, because they said we're a California corporation and we don't want to deal with a piece of New York real estate. We're now going out again. We have better cash flow, and we're doing another round, an SBA round. Has the marketplace changed, or am I going to hear the same, silly answer?
What was the time frame again? When was the first?
2 years ago, in 2010, we tried to use this piece, and now, and then the market in New York has obviously gone up substantially. It's probably worth about $900,000, $950 now. So there's probably a little more equity.
So you have even more equity in it since
at least as good as it was, certainly.
Jane, so going back a few years as far as financials that we've seen, 2009 was really bad. That was when you look at historical financials, tax returns, that was kind of the bottom. 2010, 2011, 2012, we've improved. So just the fact that we're 3 years, 2 or 3 years down the road, and if we've got positive trends as far as the financials, we're really looking at the most couple, recent 2 years as far as looking at the analysis and kind of saying, hey, 2009, we all had a rough road at that moment, and then really focusing in on the here and now. It sounds like it was one of those cash flow issues, more of a collateral situation.
Shane?
Yeah, what I was going to say is a lot of times it depends on who you might have been going to also for that collateral. That may have said they have difficulty taking a piece of New York property for something that's a California corporation. Many lenders are pardon?
SBA.
It was SBA. So did you actually work directly with a bank, if you don't mind me asking? And the bank told you they didn't want to take it? Or?
I worked with an SBA advisor who brought it to half a dozen banks. This was early 2010, and universally they said, their advice to me was set up a New York corporation, go through the New York SBA, which was, kind of ridiculous advice in my opinion.
You know, I think with that, just from transactions that have hit my desk and kind of the responses I normally get from underwriters, when you have a piece of collateral that's separated from where you're at, you know, it's an investment property in the middle of nowhere, that's actually where a lot of cases come in that people have walked away from transactions. Not that, of course, that you would ever do that, but people who have those investment properties that are placed around the world, I mean, a lot of the short sales that come across my desk are guys that could have kept paying a mortgage but just stopped on an investment property that was elsewhere. So from what I've seen, I think maybe some of that could come in as far as the underwriting.
In 2010, when somebody came in, were you just like, okay, I'm probably going to just say no. I'm probably just going to say no. Nope, nope, nope. And now in 2012, it's like, well, maybe I'll say yes. I mean, in your own sort of attitude 2 years ago, and if he'd walked in, be like, oh, I'm already thinking no. You know, has your own attitude changed?
I always try to give someone a chance, I mean, with anything, because you never know. There might be something that looks weird up front, but underneath the story, again, goes back to the story. What happened? Where is it at? Where can we go with it?
Get your story straight.
Yep.
Do we have another question?
You have a question over here.
All right.
Just if you could elaborate a little bit on the hybrid between the term and the line of credit that came up. I wasn't quick enough taking notes on that.
Troy?
Yeah, so it's called a non-revolver to term. And so basically, it's a line of credit for the first year, except, you know, in a traditional line of credit, you use it, pay it down, reuse it, pay it down. With this, you're just drawing on it until you get to a certain amount. And then at the end of the year, we term it out. So we turn it into a term loan. And so it meets that desire of the client where they don't have to pay interest on money that they're not currently using. So it's kind of best of both worlds.
Another question?
You have a question over here.
Yes, I have a property that's valued at about $1.5 million, and I'm looking to develop about 35 units, and I'm going to put in an additional $3 million, so a total of about $4.5 million that I'm putting into the project. And I need to borrow $3 million, but I'm having a hard time doing that because I've never developed real estate before. How do you jump that hurdle?
I want to make sure I understood. The property is currently worth about $1.5 million, and you want to get $3 million more to expand it. Is that correct?
The property is valued at $1.5 million, and I'm putting an additional $3 million cash into the property. So that brings my total investment to $4.5 million. But in order to complete the project, I need an additional $3 million. Because it costs about $5 million to build. But after the project is built, it'll be valued at about $7 million with a $3 million balance, which was the $3 million that I borrowed. But I can't break into the market because I don't have any experience as a developer.
And what kind of property? It's a multi-unit?
I'm building student housings in Santa Monica.
Guys? I see Brian's already doing the math.
Wait on this guy.
I think you're getting approved.
Well, I'll tell you, anything to help our students these days. They've gotten so beat up by our recent environment. So a couple of things come to mind for me. You know, when we look at construction loans on improved properties, certainly it's very important that we look at the amount that you're investing yourself. We want the business owner to have certainly skin in the game in the project. But it's very difficult for us to take your word that the project's going to be worth about $7 million after you've invested $5 million to build it. And then you said that you were investing $3.5 million and you wanted to do a loan of $3.5 million.
I think you want $3 million.
Or
It's worth 1.5, and he wants to bump it up to 4.5.
Right. Do you currently have a note on the property today?
I have a small note of $500,000 on the property, and I had an accountant run the numbers, and they gave me the value of the property.
So about $1 million worth of equity that you have.
No, I have $1 million worth of equity that I have, and then I have $3 million cash that I'm putting in.
Yeah, the value of the property isn't enough collateral to support the cost of the improvement.
Even if I'm putting in $3 million of my own personal money.
Didn't catch that.
See, I'm putting in $3 million of my own personal money.
I see what you're saying.
And the property is valued at $1.5 million with only a $500,000 balance. So that means I'm putting in cash of $3 million, and I'm putting in another $1 million in property value.
And you want a $3 million loan.
And I just simply need a $3 million loan to build the project.
So one-to-one ratio of what your own skin to what you'd like from the bank.
Yes, basically I'm putting up $4 million, and I'm asking them to put up $3 million. And in the end, when the property is built, the only balance that I have on the property is the $3 million that I borrowed. So I'm looking at a value of $7 million with a balance of $3 million on it. But they say because I'm not a developer, I can't get a loan.
Yeah, developers, they've had a tough go of it in the last few years since the crisis. Probably the toughest business segment or industry. Jane asked us earlier, kind of what are some of those industries that we're saying yes to, and what are some of the industries that are very tough right now. There have been so many challenges with development projects that we actually own today that we really didn't want to own. And the valuation of a developer's investment into a construction project, so even if they put $3 million into it, or say you put $5 million into it in materials, labor, surveys, architectural costs, whatever those things are, it's very difficult for us to put a value on that. If you were to default and walk away from this project, chances are we would only have $1 million equity because there's already a note on the $500,000 note on the property. So it's worth about $1 million. So of those things that you're spending to invest in this project, it's a business plan. So if you're not a developer and you don't have a history of development projects and you don't have cash flow from your development company, it's hard for me to see you as being in the development business.
So what should he do? How could he convince you?
One other thing, I also own 2 other units because I'm in the real estate business. I own 2 other apartment buildings that have $2 million worth of cash, $1 million a piece in it, and I still can't get a loan. And I was willing to use those 2 properties as collateral as well. So that's a whole lot of money that's being put into the pot.
Well, if the numbers really bore out by an appraisal or whatever, that you had $2 million in collateral and $1 million in equity, and he's seeking $3 million.
And I have 2 other properties that go along with that. I mean, I'm willing to sit down and talk. Give me your card.
I would love to talk to you. And
can I get your card?
Yeah, absolutely.
Can I get it now?
Well, we're almost. We're going to take one more question. Come on out. Come on out.
We do have a lot of bankers in the next room from most of our banks, but we do have real estate specialists and development specialists. But development, especially residential real estate development, has been very tough to look at as a project because we want to understand what the risks are, and we have to be able to disclose to our regulators and shareholders what will happen if they stop making payments on this.
As opposed to some other sources, you have shareholders and regulators to answer to. So one last question. Anyone?
Question over here.
Oh, thank you for coming today and speaking to us. You were mentioning earlier about the distinction between a tax return problem versus the health of a business, and one of the things that you can use in a business is obviously depreciation. Mm-hmm. So my question to you is how you treat depreciation in terms of adding it back perhaps to cash flow for your analysis. And then the second question I have for you is in an environment that we've just gone through where we've seen literally hundreds of banks basically go out of business, there's a protection for the depositors in terms of the FDIC insurance. What kind of protections could you suggest for your borrowers so that if they in fact get a line of credit from a bank that ends up failing, what kind of protections can they have that their businesses won't be impacted by that failure? Thank you.
All right, depreciation and line of credit protection.
All of that is typically added back. So any non-cash expenses that are simply a tax tax write-off that you're allowed that aren't actual dollars that came out of your pocket. All of that, when we're looking at the true cash flow for your business, just gets added back into that number to help us generate it. So we calculate the earnings before interest, taxes, depreciation, and amortization. So as far as your ability to service the debt, and you asked the question earlier about taxes and how the impact that it has, usually we net that, we take that out of the equation and look at it because your monthly payments are coming before you have to pay your taxes. So we'll look at the cash that you have before any of those come into play. But then we also have to look at it when we're looking at small business owners, look at the impact that it has on you after the fact as far as helping you survive. So we'll look at the business on how it cash flows on its own, and then as Brian said, we'll go into you personally and make sure that after all of this is taken into effect, that you'll still be able to take care of your own personal debts and live, because we're not just lending to the business, we're also taking you as a guarantor.
It's the difference between EBIT and EBITDA.
Yeah.
Well, and one thing to add to that mix too, the more we know about you and the tax returns in the business, we can also look for what are called non-recurring events. So maybe in the prior year, you had a litigation expense, you had maybe there was a small fire. I mean, there's kind of a one-time event where we could add that back also into the cash flow to help improve things, in addition to depreciation and everything else that Shane mentioned.
Very quickly.
Yeah.
Protection for line of credit the way you have in your bank account.
I guess the most important thing is be with a bank.
Pick the right bank.
Be with a bank that has a track record of strength. Be with a bank that you can understand their history and their strength. We've just gone through a very turbulent time when it comes to banks. But typically what I've seen, because my bank has acquired a few banks that had some trouble, and we acquired their loan portfolios, and we've become then the servicers of those loans and have honored those loan agreements. The risk of you being harmed if your bank goes into failure or gets acquired by another bank. One of the things that the FDIC does and works very hard at is matching up banks with other banks. The FDIC is not a bank, and they don't want to be in the banking business. They don't want to manage people and take calls from customers. When a bank goes through a failure event, they typically get matched up with a stronger bank, and the FDIC can work as an intermediary for that deal. But the customers on the lending side are typically intact, and then immediately start a new servicing agreement with the acquiring bank.
All right. Brian Moeller, Shane Pearson, Troy Bosch, thank you very much. Thanks, folks. Enjoy the rest of your day.